Well, happy Monday. It is October 23rd. Want to bring you the latest data here in the Austin metro area on a lovely rainy Monday. I'm going to start here. This is a chart from John Burns Real Estate Consulting. This is national, and it's looking at how have prices changed from the lows of the 2020 pandemic to today. So incomes, they're up about 13% nationally. Home prices are double. They're up about 28% nationally. But look at the mortgage payment, which is the combination of the price and the interest rate, 89%. So if you're buying a house today versus when you bought it back, maybe in the low of 2020, you're almost double what it costs on a monthly basis to carry that house. That is what's impacting the market more than anything, is the fact that the mortgage payment is just so much more expensive. It's going to lock sellers into their properties who don't want to have to go pay 90% more to buy a house. It's also making it harder for first-time home buyers who have to they feel like they're chasing their tail trying to save up more and more money to keep up with the interest rates that are pushing that house. This is looking at what builders are doing on a national level to battle that rate and to keep buyers coming in to buy. So 30% of the builders are doing a full-term rate buy down. So they're giving, 20 grand towards the buyer's closing costs. The buyer then gives that money to the lender, and the lender can do a permanent interest rate buy down. About 24% aren't doing anything. Another 17 are doing some flexible spending, like, hey, here's 20 grand. You can either use it to knock the price down, or you can give it to your lender to buy down the rate, or you can give 10 grand to your lender to buy down the rate and save 10 to cover the rest of your closing costs. There's a mix in there, again, just similar rate programs. And then 14% are doing a temporary buy down, which is like a 2-1 or a 3-1 buy down program. Basically, though, if you take this 24%, that means 75% of builders right now are focused on helping buyers lower their interest rate with closing cost credits. We're seeing that spill over into the resale side as well. A majority of the contracts that we have right now under contract, the buyers are getting some kind of credit from the seller to give to their lender to buy down interest rate. So we're seeing that on a high level. Here's why. Last week was tough. We hit 8% interest rates for the first time since the year 2000. Right now, we are just a hair below 8% on the 30-year fixed. Odds are we're going to hit it again, 8% today. The reason is the 10-year treasury just continues to get weaker in terms of buying. There's not a lot of interest there. There's a lot of supply. And so that's driving the yield up. And the same thing happens on the mortgage-backed security side. There's just a lot of uncertainty with Washington, with global wars, with, sadly, ironically, a healthy economy, which isn't letting inflation come down. There's just a lot of things that are affecting that interest rate. So we're seeing 30-year fixed. It's probably going to jump to 8% again today. Doom and gloom. I saw another statistic that said mortgage applications are at their lowest level since 1995. So that's 28 years. We have not seen this few people applying to get a mortgage. And the main reason is, look, a couple years ago, you were getting 2s and 3s, and now you're way up here at 8, almost, 250% higher than you would have gotten, 2 years ago. So what's happened is you've got all these sellers over here locked in. You have all these buyers up here with buyer's remorse, and it's really difficult right now to move property because of that high interest rate. Let's look locally. This is original price versus sold price. So the green is what sellers originally were listing and trying to ask on their homes. And the blue is what actually closed in terms of closed sales. We've been looking at this on a monthly level. If I look back at the end of last year, the lowest point of asking price was $475,000. That was in the winter of last year, and we were on a steep drop at that point from the peak of 2022 down into this winter cycle. We dropped in price, actual sales price, median price, down to about $430 back in February of this year. Then we had the spring run up. Sellers got kind of excited, listed their houses kind of high again, but look at the gap, huge gap. They were listing around $530 and the market was closing around $440. So it's like a $90,000 gap. That's not on an individual house, but just the market in general. There was a big gap between what sellers wanted and what buyers were willing to pay. The price that buyers were willing to pay actually went up a little bit through June. So the median price in the market came up to 475. You could see sellers quickly got the picture. They weren't going to be able to do that big run up. And the price has just ever so slightly been eroding on the list price, down, 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 down. We're now sitting about 475 in terms of the asking price. That's where we were last December. So we really haven't gone anywhere. In terms of the actual closed sales, from February, we were around 430. Right now, through the sales in October, we're sitting around 450. So the market's gone up a little bit in price from February, but you can see it feels slow and it feels like we're losing value because the sellers are seeing the list prices ticking down. But what's happening is now the gap is not that big. The list price is 475, the sold price is 450. Now it's only about a $25,000 gap. Sellers are getting tighter on their price. Buyers are realizing they probably can't get that super steep discount they thought. There's just enough activity to keep the properties moving. What buyers are getting instead, as we just talked about the builders, is they're getting closing cost credits. So this is not factoring in the fact that a buyer might be buying that house at $450,000, but they on the back end, they might be getting 5, 10, 15, 20 grand from the seller to help buy down their interest rate. So that's one of the big things that we're seeing there. This is a heat map. If you just want kind of a visual, don't go too deep into it, but downtown is in this little pocket right here. Ignore this little red area. We looked at that yesterday or last Friday. My assistant and I were kind of like, why did this little one zip code go up 30% or more and everything else is cooling? It had to do with there was one condominium complex in that zip code that sold all brand new construction, kind of pulled the price up. But other than that, it's cooling like everywhere else. So this just tells you, I wouldn't read too much into this in terms of long-term appreciation or depreciation, but it just shows you in general, 0 to negative 10% is the light tan, 10 to 20% down is the lighter green. The darker green is 20 to 30%. So what we're seeing is generally we're seeing cooling across the market. And this is between January and September of 2022. And remember, January, February, March, April of 2022, the market was skyrocketing up in price. It went up $75,000 in median value in 4 months. So that was the end of the pandemic when it was crazy. It way overshot. And then September, it had started to cool off, but just barely. This year, we had already way cooled off. So this is showing you probably the biggest gap, the biggest change that we've had. And I expect these numbers will narrow as we move forward, because now we're going to start putting that last little gasp of the pandemic in the rearview mirror. By the time we get to next year and they're looking at 2023 data, I don't expect you're going to see that big a gap, because by the time we got to 2023, the prices had already done almost all of their correcting. This is right now. Where are we right now? Number of active versus sold listings. So the green is active listings, and technically we always see a bell curve every year. It goes up in the spring, peaks in the summer, listings start coming down in the fall, but they've really held on. And I think the reason is you can see the blue is sold data. We're just seeing buyer activity continue to erode because of those high interest rates. We had 6% rates, high sixes, into the midsummer. We got 7% around August, and now we're sitting almost at 8%. So we've seen almost a 2 full percentage point rise in the mortgage rate over the last 6 months. And what's happening is we're just seeing, we peaked out in May, which is really your spring buyers, your March, April buyers closing in May. We kind of peaked out there, and then we've just eroded away buyer activity. Last month in September, we closed around 2,300 sales. That's just not a lot of sales. We're still going to see more in October, but right now we've only closed officially 1,200 sales in October. So really low number. And what's happening is instead of this peaking off a little harder, it's just barely coming down because there's not enough buyer activity to pull more listings off the market. We are going to start to see some sellers. I expect we're going to see more sellers start to see expired listings or withdrawns or things like that. We're not seeing it in big numbers, but we're going to start seeing that. If I go to the homepage of the MLS right now, 234 homes withdrew off the market in the last week. 78 listings expired. 92 went into hold status, although they could come back on the market. Sometimes that's just to do a repair. or something like that. But those aren't huge numbers. Price decrease are huge numbers. On a weekly basis, 1,400 homes are decreasing in price almost every week. And I think Austin leads the nation. I was on a webinar last week. Austin's seeing about 56% of all properties in the market are going to have a price decrease within a 30-day window. So way over half of properties are going to have to see a price decrease because we're just searching for those buyers. It all goes back to the very first chart I showed you, which is when mortgage rates go up, and that was nationally. We could be higher in Austin. Our mortgage, I wouldn't be surprised if our total mortgage payment is up well over 100%, not just because of the mortgage rate, but in Texas, we also have the property taxes, which reassess every year. And in 2021, they went nuts, or 2022, in reaction to 2021, property taxes went nuts and shot way up through the roof. And so it's just increasing that mortgage payment for buyers. That's a lot of information to go over. I'm going to take you back to this heat chart here. I think if you're a seller right now, you just got to expect the market's going to take longer than normal to get a property under contract, to get it sold. The buyer activity is extremely low because of high mortgage rates. And on top of that, we're now heading into just normally a seasonally slower period. Not yet. October should be okay traditionally. But as we start getting into, let's say, the second week in November, you're going to feel whatever buyer activity is out there, you're going to feel it drop off a little more, because at that point, buyers, if they don't buy a house, they start sitting on their hands, they start waiting for the holidays and move on. So it is going to get slower. The rental side of the market isn't that much better. And we've talked about this in previous videos, but what we're seeing is any seller who can't sell, some of them will just take the house back. Other ones will just shift it over to the lease market. So it is creating more supply in the lease market at a time when traditionally leasing is harder. This time of year, there just aren't as many people moving around. And when you don't have as many sales of houses, you're not creating more tenants. Sometimes people sell their house, they don't go buy another house, they might just go rent a house for a year or two. So there's just not a lot of movement in the market. And that's why we're seeing this kind of buildup of inventory, is there's just not as many people moving. So that's something to keep an eye on if you're a buyer right now. I think you got to have a great relationship with the lender that you want to work with, because rates are still really volatile. They're just moving every day. And we want to keep track of, if I go back to this mortgage rate chart and if I zoom into it real close, this is July and August. I mean, they're going up almost every day, up and down. You really want to have a good relationship with the lender, because they're the one who's bringing the money with you and can help you get to the closing table. You don't want to be buying right at the top of your ceiling, because if that rate jumps on you, then all of a sudden you can't afford that house. So we want to get into a situation where you can afford the property. And ideally, if it works out, maybe we can get some credit from the seller or from the developer to help you buy down that interest rate. We'd love to talk to you in more detail if you're looking to buy, sell, or invest in real estate here in the fourth quarter in Austin. You can follow all these videos on our YouTube channel at Ryan Kelly Group on YouTube. Until then, you're going to need an umbrella this week. We have a good chance of rain, which we need, but hopefully we get some good rain, and ideally we get some good news as well in the market that will help soften interest rates just a little bit. Until then, I will talk to you guys next week.